What's up, guys? I'm Nobody Special. And as we speak, Netflix shares are in free fall, down 23% as of the making of this video, on news that the company didn't quite add as many subscribers as they were hoping for, and that subscriber growth in the future may be lackluster. This is just another sign that the era of the mega growth tech stocks is coming to an end, and it's time to get back to basics. You ready? Hit it. Thank you for joining me. I'm Jack Gamble, and I'm Nobody Special, and Netflix is absolutely in the toilet today. The stock is down over 23% and still selling off. The company reported yesterday, and though they reported a pretty decent quarter, the new subscribers was not what the market was hoping for, and they posted a warning that the subscriber growth in the future is going to be far less, and this has the market rushing for the exits to dump Netflix stock. Now, for the better part of a decade, Netflix, along with the other FANG names and the whole NASDAQ, has really dominated the stock market, while value names, in particular energy, have been treated like redheaded step companies. But we're seeing a change right now. Since the start of the new year, we're seeing the NASDAQ is selling off hard and the money is flowing back into value. And I think this is a sign of a long overdue secular rotation from tech back into value, and you need to pay attention to this, especially if that big sell-off hits later this year. It's time to get back to the basics. When the sell-off starts, people are going to be worried about how are they going to eat and how are they going to heat. They're certainly not going to be worried about the next season of Tiger King or the ESG scores of their favorite cloud computing companies. Now, before we get into some of these numbers, folks, I have to ask, could you please like this video, subscribe to my channel, and hit that notification bell? It really helps me out, and I'd be forever in your debt. Now, also, folks, before we get too far into this detail, I have to say I'm not a financial advisor. This is not financial advice. This is only financial edutainment. I want you to do your own research, your own DD, arrive at a decision that is right for you based on your unique situation. And now, with that, it is that wonderful time when we shrink my big, fat melon of a head. And let's get into this article here. Netflix shares fall 20% on slowing subscriber growth. This is dated last night on CNBC. Netflix reported fourth quarter earnings after the bell on Thursday. The streamer beat on both the top and bottom lines, but shares plunged in after hours trading on slowing subscriber growth. The company said for the first quarter of 2022, it expects to add 2.5 million subscribers compared to nearly 4 million added in Q4 of 21. Now, this is very important because when people buy Netflix stock, they're not buying Netflix's earnings, at least not their earnings this year. Netflix is one of these mega growth big tech stocks where everybody has been paying these ridiculous multiples, ridiculously high valuations for future earnings, which means as long as that growth keeps up, those multiples will keep expanding. Well, Netflix just warned that that growth won't be there in the future. So now you have multiple compression where the company is going to start trading at fewer times what it earns in a quarter. And you also have to factor in, especially with these big growth names, that we live in an age of high inflation. And inflation is tomorrow's dollars getting less valuable. So people will pay less money now for earnings next year, because next year those dollars aren't going to be worth as much. So you've got inflationary headwinds and you have signs of this growth is slowing, and this is a disaster for these big growth tech names, namely Netflix. And just to show you what that looks like, here we are right now with Netflix trading at $389, and look at this sell-off today from $508 yesterday down to $389. We're down 23.3%. And I just want to give you a little bit of a hint. Look at this chart here. Look at this 1-year chart. Look at this 5-year chart, okay? People have been paying these increasing valuations for this growth for years. Well, it's time for those multiples to come back down to earth. And you can see here, just based on what we were trading at a few years ago, Netflix stock still has a long way to go, folks. So maybe we get a rebound in Netflix shares in the short term, but I think overall this trend will continue down for the foreseeable future. And it's not just Netflix. Check out this story on Peloton. I mean, talk about a high-tech growth name. People paying thousands of dollars plus a monthly subscription fee for a stationary bike. Folks, it's a stationary bike. I get it that there's a little TV attached to it and you can have somebody, cheering you on while you pedal, and that sounds great. But it's a stationary bike, folks. You can buy these things used on Facebook Marketplace for $50, for crying out loud. Look at this story here. Peloton to halt production of its bikes and treadmills as demand wanes. Peloton is temporarily halting production of its connected fitness products as consumer demand wanes, and the company looks to control costs, according to internal documents obtained by CNBC. The company said in a confidential presentation dated on January 10th, which apparently was not that confidential, The demand for its connected fitness equipment has faced a significant reduction around the world due to shoppers' price sensitivity and amplified competitor activity. Peloton plans to report fiscal second quarter results on February 8th after the market closes. As the unfortunate health situation becomes less and less prevalent in people's lives and people start to get at least somewhat back to normal, we might see people going to the gym again. We might see people exercising outside again, and that certainly is not very good news for Peloton. But also, people are starting to come to the senses and realize this is just a ridiculously overpriced exercise bike. That's really all this is. And it's not worth what they charge, and they're going to have to slow down their production, and ultimately they're going to have to drastically reduce their prices in order to be competitive. That means those future earnings, besides the inflationary pressures, those future earnings are not going to be there. And also keep in mind, Peloton is not even a profitable company to begin with. So things not looking good for this company. And again, looking here at a 1 month chart, Peloton starting the year around $40 a share, and we are down around 25 now. Not looking good. Looking at a 1 year chart, really this decline has been happening for the better part of a year. And of course, look at the ridiculous price, $151 it was trading at in December of 2020. Again, these prices have to come back down to earth. Folks, valuations matter. That is going to be a recurring theme in 2022. As economic turmoil sets in and as inflation gets worse, it's not about growth. It's going to be about reality. It's not going to be about the future. It's going to be about today. People are going to be worried about how are they going to eat? How are they going to heat their homes? How are they going to fill up their fuel tank? And they're not going to be worried about earnings 10 years from now. And I just want to mention this. I found this totally hilarious. I saw this on Twitter yesterday. Gotta love Zero Hedge. He says, U.S. Steel should buy Peloton for all the scrap metal in inventory. And I definitely LOL'd at that one when I read it. Gotta love Zero Hedge. Now look, this is not limited to just a few companies. Netflix and Peloton are some pretty extreme examples. I want to show you what's going on in the major indices this year, okay? Looking at this chart, what we're seeing, the candles, that is your NASDAQ. The blue line is your S&P 500, and the purple line is the Dow. Now you can see this is a 1 month chart. It's been a rough start of the year for all of the major indices, obviously, right? But if you'll notice, the NASDAQ is down way more than these other indices. The Dow actually treading water, down about 0.4% over the month. The S&P down about 2%, and look at the NASDAQ down 5.5%. And you can bet on this trend continuing. Personally, I think it's going to be a very bad year for stocks in general, but the NASDAQ in particular is going to take it on the chin here. We may actually see the Dow trade pretty well as we get people dumping these tech stocks and parking their money in the value names like the energy stocks, the food stocks, the industrials. Again, companies that make things people need, whether the economy is good or bad. And just to give you an idea of how far this could go, look how much the NASDAQ has outperformed the other indices. This is a 5-year chart, folks, and we started back here 5 years ago relatively even. Hey, the Dow, it has had a good couple of years, up 75%. S&P has also had a good couple of years, up 98% over 5 years. But look at the NASDAQ, up 155%, even after the bad start to the year. Up 155% over the last 5 years. This chart has to come back down to earth to be a little more in line with the S&P and the Dow. And keep in mind, the S&P and the Dow are likely headed much lower themselves later this year if and when that big one ever sets in. So right now, folks, you still have a way overvalued tech sector as a whole. The NASDAQ is going to plummet. It is time to get out of those great big high-flying tech stocks. Again, not a financial advisor, not financial advice. This is just financial edutainment. I want you to do your own research and your own DD and arrive at a decision that's right for you based on your unique situation. So long story short, it's been a really rough start of the year for the NASDAQ and for these tech stocks. It's going to get worse because people are starting to realize that these stocks are way overpriced, that their products are way overpriced, and that the future earnings, because of the inflation story, are not going to be worth as much as people used to think they were. And when you zoom out on that chart and you look at just how much the NASDAQ has outperformed the other indices over these last few years, you can see these tech stocks are still way up in the clouds and they've got a long way to fall. As far as this melon head is concerned, I am getting back to basics this year. I am focusing on stocks that deal with energy, stocks that deal with food, and of course, precious metals. I'm getting back to basics. I'm getting out of these tech unicorns and rainbows. These tech stocks are way overdue for a secular rotation out, and I think this is finally the year that it happens. Guys, I want to thank you for your time. Thank you for watching this video. Don't forget to hit that thumbs up button, subscribe to my channel, and hit that notification bell. It really helps me out, helps me to keep this channel growing. And until next time, live small and dream big.